ALASDAIR, thank you so much for joining us today.
That's my pleasure.
All right, well, this last Friday was the 10-year anniversary of the Lehman Brothers collapse. Can you share with our viewers a little background on this? What happened 10 years ago that brought the United States into the greatest recession since the Great Depression?
Well, 10 years ago, we had one of those periodic events, which actually is called a credit crisis. It is amazing, actually, that people don't seem to understand that it's a credit crisis. It's not a speculative crisis. It's just too much credit is created in the system. And of course, the people who drive it are the central banks and the banks which they bridge banks to expand credit. So you're going to get this cycle of boom and bust as a result of monetary policy. And so in that sense, I think if you understand that, you understand the dynamics that led up to the Lehman collapse. The fact that it was centered on mortgages, liar loans, whatever, low standards of mortgages, that's just where it's sort of the bubble actually burst. I mean, the previous bubble was the dot-com bubble. So it was in the stock market. And if you go back and you look at all these crises, you find that there are sort of the only one common factor in it all is the expansion of money and the desire of central banks to stop money contracting, because the central banks just don't like the idea of what they call deflation. They think it destroys businesses. They see it as something unnatural, if you like. They can only see one way. They don't understand the process of creative destruction which you would get in an unfettered free market economy. This time, what you've had since the Lehman crisis is a huge, great build-up of yet more credit. And this is reflected in two ways. If you look at the global debt situation, it's funded debt, which has increased from around about just a bit under $200 trillion equivalent to something probably around the region of about $260 trillion. So the problem has got worse, not better, and it means that the solution is going to be, if you like, more violent in the monetary sense than the solution that was required for the Lehman crisis. The other measure of this is the amount of money, of fiat money, both in circulation and on the central banks' balance sheets, which are not in circulation, obviously. And that has increased in all the major central banks by a very, very significant factor. Most of this increase in the Fed has been an increase in the reserves of the commercial banks held on the Fed's balance sheet. Now, to give you an idea, before the Lehman crisis, I think there was only about 1 month where bank reserves on the Fed's balance sheet exceeded $10 billion. It got up to $2.5 trillion in the wake of the Lehman crisis. I think the peak of it was around about 2014-15, something like that. And since then, there has been some expansion of bank credit, which has led to banks reducing their reserves on the Fed's balance sheet. And the Fed has more recently taken a more aggressive stance on this with tapering. So our starting point in dealing with the next credit crisis is the system is already awash with money. So that leads me to suppose that the problem actually this time round isn't so much assets, but it's the other side, it's money itself. And if I am right, then what we're likely to see is, I suppose, what you would call pig on pork, money on top of money. And that inevitably is going to lead to a substantial revaluation of the role of money, its purchasing power in the foreign exchanges and also in terms of commodities. So I think money is now the problem more than anything else. And this sort of centers on the dollar. The dollar is a problem because not only have you got all these deposits, but also the financing of the budget deficits, which have been increasing under President Trump and are due to increase to well over $1 trillion in every year, according to the budget office, for the foreseeable future. U.S. treasuries have been bought substantially by foreign investors, and I mean, including foreign central banks. So the U.S. government's budget deficit has been effectively financed by foreign purchases of dollars. The foreigners own huge quantities of dollars now, both in terms of dollar assets, portfolio assets, and also in terms of cash. I mean, if you think in terms of the budget deficit, which leads to a trade deficit, the effect of the trade deficit is to end up giving dollars to foreigners because you buy Chinese manufactured goods, you pay the Chinese dollars, and so on and so forth. So either the central bank, which is the case in China, ends up owning those dollars, or alternatively, foreign corporations end up owning those dollars. And those dollars actually remain in the United States. They remain there as either invested in things like US treasuries, or alternatively, they are deposits held on the bank within the banking system in America. And that is now at record levels. It is quite extraordinary. Yet the markets seem to think there's a shortage of dollars. There isn't. There isn't a shortage of dollars. So I can see that initially, the first part of the next credit crisis is a reappraisal in terms of the value of the dollars on the basis that the market has got the ownership of those dollars completely wrong. And you don't have to be terribly smart to work this one out, because all the statistics are available in both the Treasury TIC data and also figures released by the New York Fed.
So 10 years ago, we saw the financial system plunge into the worst recession since the Great Depression. But, people say, well, there's new safeguards in place to prevent this from happening again. Do you think the Fed will be able to next time to step in and prevent the next crisis from happening?
Well, the whole point about issuing currency is to try and stop the system from collapsing. Will try and rescue the banks from effectively a foreign run on the dollars. That is how I see it developing. Can the government do anything about it? Well, when the solution is to just chuck more money at it, the only action that a government can then take is to try and control prices. We see this every time. We know it doesn't work. But, as far as the politicians are concerned, this has got to be a short-term expedient. Tell that to the Venezuelans. All that happens is you create black markets. It's going to be difficult to see quite how this one does turn out. But basically, the problem that we have is that it is a problem which is created by monetary policy. It is not a problem which is created by irresponsible lending or whatever. That is a symptom of the problem. It is not the problem itself. And until the monetary authorities begin to understand that they create the problem, we haven't got a hope of a solution for it.
Now, you said in an article you recently wrote that a lot of countries are seeing that this crisis is about to happen in the United States and are actually preparing for it.
Yes. I was principally referring to China and Russia. I mean, we've already seen that Russia has got rid of most of her dollars. I mean, she's reduced her ownership of US treasuries to under 20 billion now. And she has stepped up with her holdings of gold instead. So what Russia is signaling to us is that she sees exactly the problem I have just described, and that is that the dollar basically, is going to be devalued very substantially. It is not reliable as a monetary asset, and she has taken the decision to replace dollars with gold. I mean, that is quite clear, and we can see that's in the public domain. China is a slightly more complex situation because China has expanded her economy on the back of credit expansion in exactly the same way as the rest of us have. In some senses, she's tried to balance that credit expansion so that it hasn't undermined her currency. Now, there's obviously big latitudes between how much you can expand your currency with the quantity of the currency without undermining its value compared with other fiat currencies. But by and large, I think that has been the Chinese approach. But what she has done more interestingly is that from 1983 onwards, the People's Bank of China has been accumulating gold. The People's Bank of China was appointed in 1983 by the Chinese government to take over the monopoly power of acquiring all the nation's gold and silver. And at the same time, the state took on for itself the monopoly power of mining all gold within China. So China actually quite secretly has been moving in the direction of gold and away from the dollar as well. But she has substantial dollar reserves. She's got about $1.2 trillion worth of US treasuries on her books. Now, she will be watching what's going on with the dollar very, very closely because she will want not to lose more than she need on those dollar reserves, but she is prepared to sacrifice them. One way in which she's been getting rid of them is she's been spending them abroad. She has made $143 billion available to Africa so far. There's $20 billion that she's spending in Latin America at the moment. And there's around about, I think it was $25 billion that she's deploying in the Middle East. And I have no doubt that when the Syrian situation comes to an end, China will be in there spending more money rebuilding. She will be spending dollars, not her own money. So that's the way in which she is using her dollars. But it is clear that China and Russia between them and all the Asian states which they influence do take the view that the dollar is in some sort of end game. And we've even seen India. India is an interesting one because its citizens have been acquiring gold for a long time, ever since the law was changed back in 1992 to permit ordinary people to accumulate gold. And the central bank, the Reserve Bank of India, has basically been unable to go into the market and buy gold. And the reason for this is that she follows Keynesian policies. And the central bankers, the governor of the Reserve Bank, is always appointed by the Bank of International Settlements and the Bank of England in consultation. This is meant to give sort of stability, if you like, to the monetary system in India. But what it's done is it's meant that the Indian central bank has not been able to accumulate gold because the policy amongst the major established central banks is that gold is effectively being demonetized. So, but India has now begun, believe it or not, to begin to accumulate gold. She has failed to persuade her citizens to lend the state or make their gold, their physical gold, available to the state. So they have actually been forced into the market to begin to buy. Now, that's actually quite a big departure. And I think that tells us that there is something afoot, if you like, in government circles in terms of their evaluation of the dollar.
Now, a lot of people know what happened in the United States. We plunged into the worst recession since the Great Depression when this crisis happened 10 years ago. But they might not know what happened in Europe, where you're from, the UK. Can you explain for our viewers what occurred when the US plunged into this Great Recession?
Well, it was similar because the problem that America faced was, if you like, the trigger for the same problems which were all occurring elsewhere. The governments in the Eurozone, some of them were just incredibly profligate. They had been borrowing and borrowing and borrowing. And not only that, but the Italians and the Spanish and the Greeks and the Portuguese found that the great advantage of being in the Eurozone was that because the rate at which the Germans borrowed was low, you had banks that would arbitrage between the low rate that the Germans paid and the higher rates that the Italians and the Greeks and all the rest of it would pay. So consequently, the banks, instead of putting money into German debt, they were buying the higher yielding euro-denominated debt issued by Greece and all the rest of it. So you had a banking crisis, if you like, that developed on the back of that. The ECB had to reduce interest rates substantially in order to rescue the Eurozone banking system. And the Eurozone banks, I mean, the German banks, who you would think were sort of pretty stable, actually got themselves into great difficulties because they took on, through Irish subsidiaries, enormous amounts of these securitized US property loans, which mortgage-backed securities and all the rest of it. So they lost an awful lot of money on the back of that, and they didn't have if you like, the Fed buying them off them, which was an advantage that the American banks had.
Now, looking towards the next crisis, how do you think Europe will be affected?
Well, the Eurozone has a different problem, and that is that America is already raising interest rates. There is absolutely no doubt that the American economy is in the mature phase of its credit cycle. In other words, it's running up to the period when further rises in interest rates will risk triggering another credit crisis. Meanwhile, in the Eurozone, they've still got negative deposit rates at the ECB. I mean, there's still NIRP, NIRP, negative interest rate policy. I mean, they are so far behind the curve. And this is one of the things that's been driving the dollar up, because speculative funds have effectively been borrowing euros at more or less negative rates and investing them in US paper, giving them a turn of 2.5% to 3% nominal. And because you're using government securities, you can use collateral, you can gear up on the back of it. So a hedge fund can gear up, say, 10 times, and that gives it a return of 30%. I mean, what's not to like about that? So you can see how these different interest rate differentials on high quality paper are just driving purely speculative flow to the dollar. And that's dangerous, because that's got to get unwind at some stage.
Now, before we let you go, if we could briefly discuss the precious metal markets. What is your perspective on the really downturn we've seen in both gold and silver?
It's all about the dollar at the moment. Everybody's been selling absolutely everything. I mean, currencies, commodities. Your grandmother even has been sold for the dollar, shorted for the dollar. And under those circumstances, we've had record short positions amongst the speculators, the hedge funds, as it were. The hot money has been shorting gold in record quantities, and the same with silver. And it's the most unusual situation. Now, that will correct, and those bear positions will have to be closed. The question then is, what will actually force their closure? I mean, the answer basically is that when the steam starts coming out of the dollar, I think you'll find that the shorts will get very, very badly squeezed. Now, I don't know whether the dollar is going to go down or up in the very short term, but what I do know is that if you look through the next month or two, the dollar has actually only got really one way to go. And so I would say that if not now, from later on this year, maybe from slightly higher up, the dollar, I think, has got considerable downside. Now, what that means as far as precious metals are concerned is that you shouldn't go too far wrong owning them at this price. And it could actually turn out to be almost the purchase of a lifetime, because if I'm right about the dollar, then the other side of that, of course, is people will be going into precious metals. Because it's not just the dollar. I mean, when the dollar starts falling, the other thing that you will see is that every central bank which uses dollars as their primary form of reserve will be considering the valuation of their currencies and how they should amend their monetary policy in order to take account for the dollar's fall. And because they are predominantly Keynesian, they think that, well, high currency is bad for business, low currency is stimulative for business. So they're likely to use the dollar for, if you like, to get their own currencies down as well. And that's another reason why the best thing you can possibly do is just get out of the fiat money system. Have some of your liquidity, if you like, away from that and in precious metals.
All right. Well, ALASDAIR MACLEOD, thank you so much for joining us today.